Hello and welcome to our conversation on financial analysis. Um, in this session, we will understand the Dupont analysis. But to do that, we will take an example of one of the latest IPOs, that is Burger King India Limited. And we'll use the Burger King India Limited's financials to understand the concept of the DuPont analysis. So Burger King is one of the largest quick service restaurant chains in India. The initial public offering of Burger King which is one of the fastest growing quick service restaurant chain of India, turned out to be um, one of the largest IPOs in 2020 because it crossed a subscription mark of 150 times. That means it is oversubscribed by 150 times. The strong interest of the market of the investors in Burger King India was due to the strong brand of the company, reasonably healthy financial prospects, and an expansion, a massive expansion of QSR all over India. But who owns Burger King is an important question for us to understand. The Burger King Limited is before the before this particular issue, the QSR Asia Limited holds about 94% of the total shares of Burger King India Limited. And the QSR itself is a subsidiary of FNB Asia Singapore. FNB Asia holds about 86.9% stake in QSR Asia. And FNB Asia is a 100% subsidiary of FNB Asia Venture Limited, Mauritius. And FNB Asia Ventures Limited, Mauritius, is about 45% of the stake is held by Everstone Capital Partners, which is an investment company which also holds share in the parent company of the Burger King. So we can see that the chain of the holdings and the shareholding pattern. Burger King is a subsidiary of QSR Asia, which is a subsidiary of FNB Asia Singapore, which is a 100% subsidiary of FNB Asia Mauritius, and which is partly owned by Everstone Capital Partners. Now, the new issue of the latest IPO of Burger King is partly for divestment of QSR and partly for the new issue of shares. Now, with this, let us see their financial statements before we pick up the DuPont analysis. The Burger King equity is 2,754 million. These are all in million. And this 2,754 million consists of capital, which is 2,777 million, but reserves of negative 64 million. But it's important to observe that the company is having huge negative retained earnings, 3,400 million, which is increased from 2,600 million. So, which is it can be seen that continuously the company is making loss in the last 2 years. It is 383 and gone up to 766 million rupees. as a loss. So we would like to understand and undertake the Dupont analysis by using the balance sheet and income statement of Burger King. So let us see what is Dupont analysis. The Dupont analysis provides a framework to examine the drivers of return on equity, and return on equity is PAT by equity. The Dupont analysis says that the overall profitability of the company depends on the PAT by sales, which is a reflection of profitability, sales by TA, which is a reflection of the efficiency, and TA by equity, which is a reflection of the leverage of the company. So the return on investment, in this case the return of equity, is a product of profitability, efficiency, and leverage. Now let us see this ROE of Dupont, of Burger King. Now we can see that the return on equity of Burger King is minus 27%. Minus 27%. That means the profit by equity is negative 27%. But why it is negative? In order to understand and use the Dupont framework, let us drill down and examine the drivers of ROE. According to the Dupont analysis, the ROE is a product of profitability, efficiency, and the leverage. So the PAT by sales itself is negative. PAT by sales is 9%, negative 9%. So PAT by sales is equal to the profit after tax divided by the total revenue, and let us see that the revenue has increased during the period. The revenue has increased from 6,000 million, 6,300 million to 8,400 million. Despite the increase in the revenue, the losses have increased from 383 million to 766 million. And according to the Dupont, the ROE is a product of the profitability, efficiency, and the leverage. Now, whether they're using efficiently the assets or not, we can comment only by comparing this turnover ratio or efficiency ratio with other competitors. For example, in India, for Burger King, the nearest competitor may be the Jubilant Food, which owns the pizza company. In this example, we are not doing any comparison, an inter-firm comparison or intra-firm comparison. All that we are trying to do is to examine the drivers of ROE for a particular year, and that year is the year of IPO of Burger King, that is March ending 2020. Now, according to the Dupont analysis, now each of these components can be further drilled down and then see what drives profitability, what drives efficiency, and what is the composition of the leverage. So let us pick up the profitability. So profitability, which is backed by sales, depends on the tax effects, or rather affected by the tax effects, the interest effect, and the operating expense effect. So therefore, the profit by sales can be further drilled down as backed by PBT, which reflects the tax effects. If the tax is high, because you are not using some of the provisions or the incentives given, maybe backed by PBT will be low. And the interest effect will show whether a significant part of your business is fund or your income is eaten away by the interest. So PBT by PBIT. What percentage of PBIT is PBT depends on what percentage of your expense is interest. And the other expenses in the income statement are captured by OPEX. PBIT will be high if operating expenses are low. And PBIT by sales will be low if operating expenses are high. So therefore, PAT by sales can be managed by managing tax effect or managing interest effect or managing the OPEX effect. Let us see what is this OPEX effect. Now this OPEX can be further drilled down into individual expenses. For example, COGS, we know that PBIT is equal to sales minus COGS minus other expenses like salary, depreciation, amortization, and other expenses other than the interest. So therefore, in order to manage PBIT by sales, we need to manage the expenses. In order to manage the expenses, we need to understand what is the present position with respect to individual component of the expense. Then only we can take a decision which expense can be reduced. Now let us see the profitability analysis of the of Burger King. So if you observe, the PAT by sales is negative because of the tax effects, as we mentioned, because of the interest effect, and because of the OPEX effect. Now, in order to understand in order to manage the PAT by sales, the company has to examine why is the tax so high, why is the interest high, or why is PBIT high. If you observe here, we'll start from PBIT by sales. PBIT is minus 125 million already. So that means we are not, the company, the Burger King is not even able to meet its operating expenses, is not able to meet its operating expenses. Therefore, you can see that it is minus 1.5% because the expenses account for more than the total operating income. The operating expenses itself, you can see that the operating expenses itself is 101%. So 101.05. And why this expense are so high? Which particular expense is high? In order to understand that, let us drill down the OPEX effect further. So cost of sales, or in other words, in this case, the main expense is the beverages and food consumed, accounts for 35% of the sales. The power accounts for about 8% of the sales. Employee cost is 16.2% of the 16.2% of the sales. The sales and distribution accounts for about 18% of the sales. The summation of these expenses account for significant part of the total operating expenses. So if ROI needs to be improved, PAT by sales needs to be improved. And PAT by sales can be improved by improving the operating efficiency. And in order to understand the operating efficiency, there is a need to see which particular expense can be managed or can be reduced. Then you see the interest effect. Interest is, you can see that interest is accounting for a significant part of the total expenses. You can see that. So interest is equal to 655 million, whereas PBIT itself is negative 125 million. No wonder the PBT is further increasing because of the interest component, right? So, so therefore, in order to increase the PAT by sales, there is a need for to revisit and examine what is this interest. And interest is high, maybe because the company is sitting on a big chunk of secured loans. We can see that there is long-term liabilities is very a big component of the total sources. The big component of the total sources is in the form of long-term. You can see that the long-term non-current liabilities account for the 63% of 63% of the total sources. And that is the reason why the interest is a significant part of the total expenses. And because interest is high, the interest effect on the profitability is significant. The tax is normally is not in your hand. It is more an endogenous variable. All we have to do is to check whether we are using, the company is using the benefits given by the tax law. So managing the ROE of Burger King boils down to managing interest and managing OPEX effect. So therefore, though there was an oversubscription of the issue and people, the investors are bullish about the company, but the company's bottom line is still in the red. So if the company works on this operating efficiency and financing efficiency only over a period of time, only then over a period of time, the PAT by sales will become positive, and then over a period of time, the return on equity will become positive. So managing return on equity, as mentioned, as given in the Dupont Framework, requires an attention for Burger King to observe their operating efficiency. Now let us see the investment efficiency, or the efficiency with which the assets are being managed. Here, unlike the operating efficiency, here we try to see the relationship between the sales and the asset. Is the company having underutilized assets on the balance sheet? If it is there, which asset? Is it a current asset or is it a non-current asset? If it is a current asset, then which current asset? Is it debtors? Is it debtors? Or is it stock? Or is it cash? Right? If it is a debtor or cash or the stock. So managing the assets, therefore, managing the assets is to understand whether the company is using the assets efficiently or not. And to do that, you have to, of course, undertake an inter-company and intra-company analysis. Now let us see, in the same way, the equity consists of you can drill down further to see what is the composition of equity. Is equity high because the capital is high, or equity high because the reserves are high. If the reserves are high, is because of the security premium or because of the profits that the company has been making. Let us see the balance sheet of Burger King once again. You can see that the, the non-current assets of Burger King is a significant part of the non-current asset is the gross block, or in other words, property, plant, and equipment. Okay, and a very small percentage is a current assets. So the non-current assets, which is called fixed assets, maybe account for 93% of the total assets. 93% of the total assets is the non-current asset, and significant part of the non-current asset is the property, plant, and equipment. No wonder, because that's their main business, is to have more assets, buildings, machineries. So, so therefore, that is why we are also seeing that depreciation is accounting for about 13% of the total sales. So, will the company invest more in the assets to increase the sales, or with the present assets will the revenue go up? So therefore, observing the asset and sales relationship is what is the focus of the the second part of the DuPont analysis. So sales by current assets and sales by non-current assets. So the efforts have to be made to increase the sales by current assets. Maybe at present the current assets are very low. In this type of business, you don't have debtors because everything is a cash sales. It is important that the company has to improve this, that with the existing non-current asset, is it possible to increase the sales? But is 0.75 good or bad? We can't say just like that. We have to examine its competitors and its past numbers to comment upon whether Burger King is efficiently using the assets or not. At present, the equity is consists of a significant part of equity is actually a negative reserve, and this is a matter of concern because the company is having is making annual losses. So therefore, the profit and loss of the retained earning is continuously remaining as a negative. And so the first job that the company has to do on hand is to improve the profitability, the efficiency of the business is to make the bottom line positive. The top line is increasing. You can see that the revenue has increased by the revenue has increased by 33%. Revenue has increased by 33%, whereas the loss has also increased by 200, 100%. So that means despite the increase in the revenue by 33%, the loss is increased, has become double, has increased by 100%. So that means this company requires an extensive investigation into the operating efficiency. So therefore, this particular portion of the DuPont analysis is very, very relevant for that. And this analysis can be done for its competitor and then examine how is Burger King vis-a-vis other companies, or how did the Burger King do in the past, and what is their projection. So as of now, the investors are very bullish about this company. Maybe just the price variations which will make the company's investors to make profit, but the fundamentals of the company are still on the not yet reached a position where we can say the fundamentals to be strong, because the equity is negative or very small because of the high negative retained profits, and the profits are continuously in the negative zone, despite the increase in the revenue. So to summarize and take it forward, so the DuPont analysis tells us the drivers of return on equity, and which talks about the overall profitability by showing the interrelationship between various ratios, and gives also a possibility or the scope and identify the areas where action can be taken to improve the return on equity. The way we did here, we saw that the company's um, IPO has been oversubscribed. The market is quite bullish, but the return on equity is negative 27%, and this can be examined by seeing the operating efficiency and OPEX effect, the interest effect, and the tax effect. And interest effect, we saw that a significant part of the sources are in the form of borrowings. So there is a need to prune it down so that this can, the interest burden will reduce. The operating efficiency has to be improved so that the operating burden will reduce. So the reduction in interest burden and operating burden will increase or improve the tax by sales, and which will have an effect on the return on equity. So therefore, taking an action on a specific item of the balance sheet, it will show how the impact on return on equity can change. So that brings us to the end of this session, where we try to understand the DuPont analysis with the example of the latest entrant to the capital market, which made an entry in the last week of, or rather in the first week of